On January 21, 1980, people stood in line for hours outside coin shops in New York and London. They were not selling, they were buying. Gold had just hit $850 an ounce, an all-time record. Inflation was running over 13%. The news talked about crisis every single night, and gold felt like the last safe place on earth. Here is what happened to the people in that line. Within 2.5 years, gold lost more than half its value. By the summer of 1999, it was down 70%. And if you count inflation, the exact thing gold was supposed to protect against, the person who bought at that peak waited more than 45 years just to get back to zero. Not to a profit, to zero. That moment finally came in September 2025, 45 years, for the safe asset. Quick note before we start, this is education, not financial advice. I'm not telling you to sell your gold, and I'm not telling you gold is worthless. It isn't. I'm testing a story against the numbers. The story that gold is a safe haven, and the numbers tell a very different story. You've heard the pitch. Gold has been money for 5,000 years. It survives wars, crashes, and dead currencies. When everything burns, gold shines. Central banks are buying record amounts of it, and over the last 5 years, gold actually beat the S&P 500, up around 130%, against 74 for the index. Right now, the pitch has never sounded better. And that's fair. So let's take the pitch seriously. If gold really is a safe haven, it should pass 3 simple tests. 1. It protects you in a crash. 2. It holds its value in normal times. 3. Over a lifetime, it at least keeps up. 3 tests. Let's run them. Test 1. The crash. September 2008. Lehman Brothers collapses. Markets are in free fall. This is gold's moment, the exact scenario every gold ad ever warned you about. So what did gold do? From March to October 2008, it fell around 30%, from over $1,000 an ounce down to about $700. In the middle of the biggest financial panic in 80 years, the safe haven lost almost a third of its value. Why? Because when a real crisis hits, big investors don't run to safety. They run to cash. They have losses everywhere and debts to cover, so they sell whatever still has a price. And gold always has a price. In a panic, gold is not a shelter. It's the thing you sell to pay for everything else. March 2020, same movie. COVID freezes the world, stocks crash, and in 10 days, gold drops about 12%. The exact moment the world needed a safe haven, the safe haven fell too. Now, in both cases, gold recovered later, and recovered hard. After 2008, it doubled by 2011. After the 2020 dip, it hit a new record within 5 months. That's real, and it matters, remember it, because we'll come back to what it means. But be precise about what actually happened. Gold rose after the crisis, when governments printed money to clean up. During the crash itself, the one moment a safe haven has a job to do, it fell with everything else. Then came 2022, the cleanest test in decades. Inflation in America hit 9.1%, the highest in 40 years. This is gold's one famous job, the inflation hedge. So what did gold return in 2022? Roughly zero. Flat for the year, while consumer prices rose 8%. You could own the inflation hedge through the biggest inflation wave of your lifetime and still lose around 8% of your purchasing power. And that's not bad luck. Researchers checked every year since 1900 when U.S. inflation ran above 3%. In 13 out of 28 of those years, gold lost real value. The famous inflation hedge fails almost half the time inflation actually shows up. Test 1. Failed. Test 2. Then. Forget crashes, does gold at least hold its value in normal times? Ask the buyer from January 1980. Gold fell from $850 to $252 by August 1999. 70% gone. And during those same 20 years, consumer prices roughly doubled. Measured in real purchasing power, our buyer lost around 85%, and it did not come back for decades. Not a bad month, not a bad year. 20 years of falling, then 25 more to break even. An asset that can lose 85% of its real value and stay down for a generation is not a stable store of value. It's a volatile commodity with 5,000 years of good marketing. Gold's price swings are roughly as big as the stock market's. Same storm, and as we're about to see without the engine. And if you're thinking, sure, but that was the 80s, things are different now. Look at the last 5 months. On January 29, 2026, gold hit its all-time record, $5,597 an ounce. The headlines sounded exactly like 1980. New era, the ultimate safe haven. This time is different. Today, as I record this, gold trades around 4,200. That's roughly 25% down in 5 months. And here's the uncomfortable part. Nothing collapsed. Stocks didn't crash. A new Fed chair was nominated. Real interest rates moved. The dollar got stronger. And a quarter of the safe assets price simply evaporated. I'm not predicting a repeat of 1980. Nobody can. But the pattern is the same. Inflation fear, record price, excited headlines, lines of new buyers. And the people who buy at the top of that mood carry all of the risk. Test 3, the long run. Over a full lifetime, does gold grow your money? This one has the clearest answer in finance. The Global Investment Returns Yearbook tracks every major asset class back to the year 1900, 125 years of data, 35 markets. After inflation, gold returned about 1.3% per year. Stocks returned 6.6%. That gap sounds small. Watch what it does. Put 10,000 into gold for 40 years at that historical rate, and you end up with about 17,000 in real purchasing power. Put the same 10,000 into the global stock market, and you end up around 129,000. Same money, same 40 years, more than 7 times as much. Why is gold so weak over long horizons? Warren Buffett explained it with one picture. Take all the gold ever mined, about 170,000 tons back in 2011 when he wrote this, melt it together, and you get a cube roughly 21 meters on each side. It would fit inside a baseball field. At the time, that cube was worth $9.6 trillion. For the same money, Buffett wrote, you could have bought all the farmland in the United States, plus 16 ExxonMobils, and still had $1 trillion left over. Now, run the clock forward 100 years. The farmland has produced a century of food. The companies have paid out a century of profits. And the cube is still a cube. It grew nothing, earned nothing, paid nothing. Its price depends on exactly one thing, what the next buyer is willing to pay. That's not an investment with an engine inside. That's a bet on other people's fear. And you pay rent to hold that bet. The biggest gold fund charges 0.4% every year. Physical coins cost you 3 to 8% above the metal price the moment you buy them. Professional vault storage adds another 0.1% a year, sometimes more. So gold's full offer reads like this: no income, decades-long losing streaks, panic selling in crashes, and an annual bill on top. There is a financial product that works exactly like that. It's called insurance. Hold that thought. But first, the obvious objection. If gold is such a mediocre deal, why are central banks buying more of it than at any time in 70 years? Because they are. Over 1,000 tons a year in 2022, 2023, and 2024, more than double their pace from the decade before, the fastest buying since 1950. That buying is real, and it's a big part of why the price exploded. But look at who is buying and why. The heavy buyers are central banks like China, Poland, and Turkey. In 2022, Western governments froze Russia's currency reserves around $300 billion, switched off within days. Every central bank on earth took note. Gold in your own vault is the one reserve no foreign government can freeze. That is not an investment thesis. That's geopolitics. A central bank doesn't save for retirement, and it can print its own money. You can't. Copying its gold strategy makes about as much sense as copying its money printer. So here's the honest verdict, and it is not gold is trash. Gold does do one thing well, and it deserves respect for it. Over very long periods, it has roughly preserved purchasing power, plus a little, that 1.3% real. An ounce of gold bought a good suit a century ago, and it buys more than one today. Gold also moves independently from stocks, and sometimes it rises exactly when they fall. In 2022, stocks lost 18%, bonds lost 13%, and gold, simply by standing still, beat them both. Studies suggest that a small dose, around 5% of a portfolio, has historically made the ride measurably smoother. But look closely at what that description is. Something that costs a fee every year, does roughly nothing most of the time, and occasionally softens a very bad year. That's not a safe haven. That's not a growth engine. That is an insurance policy, and nobody sane calls their fire insurance an investment strategy or puts half their wealth into it. So here's what you actually do with this. First, rename gold in your head. Not safe haven. Not investment. Insurance. Get the name right, and the right size follows automatically. A small slice, somewhere between 0 and 10%, not the core of your wealth. You insure the house. You don't live in the insurance. Second, if you hold it cheaply. A low-cost gold ETF charges around 0.1 to 0.25% a year. Dealer coins cost 3 to 8% extra before you even start, plus storage, plus a discount when you sell. Unless you truly want metal you can touch, the expensive version is simply worse insurance. Third, never buy the spike. The two most expensive mistakes in gold's history were made on its two proudest days, the record of January 1980 and, quite possibly, the record of January 2026. If gold deserves a place in your plan, it deserves it at boring prices, bought on a schedule, rebalanced once a year. If you only want gold when it's in every headline, you don't actually want gold. You want to join a crowd. And fourth, let productive assets do the growing. 6.6% real against 1.3 over a working life. That is the entire game. Stocks are the engine. Bonds are the brakes. Gold, at best, is the airbag. And nobody drives to work on an airbag. One line to take away. Gold doesn't protect your money from crises. It protects you from the feeling of being unprotected. And at the 1980 peak, that feeling cost 45 years. If this changed how you see the shiny cube, subscribe. Next time, we take apart another comfortable story the finance industry loves to sell you. And tell me below how much of your portfolio is gold right now. 0, 5%, or way more. Be honest. I read everything.